We use this graphic with every single person that we build a financial plan for, whether they're pre-retirement or they're in retirement. It's super important because even if you're not at retirement or in retirement yet, knowing how to actually fund it informs you what you should be doing to save and prepare for retirement. So let me just start going through it. Here shows the different areas that you can get income from when in retirement. So we have fixed income down here, and we have investment accounts up here. Fixed income can sometimes refer to bonds or any kind of interest-bearing vehicles, but in this case, we're referring to guaranteed monthly payments in retirement. So these are things like annuities, pensions, Social Security, or disability income. So these are checks that come in the mail every month, supplying you with income similar to how your paycheck would if you're not in retirement yet. We'll come back to these after I go through the investment accounts. When we talk about the investment accounts, the most important thing is the tax implications of each kind of account. The reason this is important because it's really the main difference between the accounts. Other than that, they all work functionally the same. You put money into them, you invest that money grows, you liquidate those investments, you withdraw it, and then you use that cash. That's why you can see these are arranged as funnels that funnel down into the checking account down below, and then you can use that when you're in retirement to fund your everyday needs or your living expenses. So let's go through these investment accounts up top. The first funnel here is the taxable funnel. So these are taxable investment accounts. These sort of go by a lot of different names. There's not really an agreed upon name in the industry, but sometimes you'll hear them referred to as taxable, brokerage accounts, just individual or joint investment accounts. This is really any kind of taxable investment account. So again, I'll draw up here, we have joint / individual investment accounts. These can also be high yield savings or any kind of account that again gains or grows on a taxable basis. So we do often consider high yield savings or CDs or short-term bonds or anything taxable like this, anything that you're holding that's taxable. The way that these are taxed, so you're going to put after-tax money into them. So when you receive money from your employer, presumably, or wherever you get funds from, you've already paid taxes on that. Your employer's withheld taxes, or if you got it from some other source, hopefully you've paid your taxes. And then you can then put that money into the account. So you're transferring money from maybe your checking account into this account. That money's after tax. You've already paid your income taxes. Once it is inside the account, any interest or dividends that you receive or any capital gains that you realize, you're going to have to pay taxes on. Okay? So far you can see why the account is called taxable or referred to as a taxable account. You're really not getting a lot of benefits. Now, when you withdraw from the account, assuming that you've paid all your taxes up front and your taxes while it's in the account, there's not any more taxes to be paid. You've already kind of gotten reamed on taxes a little bit, whether it's the income taxes you paid up front or the capital gains or income taxes that you paid while there's money inside the account. Okay? So nothing really special about the taxable account. The biggest thing, the differentiator between the next accounts we're going to go through, is that the taxable account is probably the most flexible. So there's no restrictions in terms of when you can put money in, when you can take money out, or how much you can put in or how much you can take out. It's entirely flexible. Again, there's just no special tax savings or tax advantage nature of this account. The next three accounts that we're going to go through, we always refer to as retirement accounts. So you can see a couple of notes down here, and these are sort of general notes. There's a lot more specifics that can go into these, but these are the biggest things to know, or the biggest things to go by at least, until you start getting into more nuanced features of these. So the biggest thing about these retirement accounts is that Congress has dedicated them to your retirement. Therefore, they want you to wait till 59 and a half years old before you withdraw from them. If you withdraw from them before you're 59 and a half, one, you're going to lose any kind of the tax advantage nature that I'm going to talk about in a second. So you'll end up paying any taxes that you didn't pay originally. And then two, you're going to have to pay a 10% penalty on any gains that you withdraw from them. So again, these are retirement accounts. These are things that you're putting money in for long term to hopefully pull once you're 59 and a half or older. Let's talk about the different ways that these are taxed. So the first one is a sort of rare account. Most people won't ever really see this, honestly, in their financial life. But this is an after-tax account. So the main two, I shouldn't say only, but the main two scenarios that an after-tax account is going to come up is in a traditional IRA that has not been deducted. So a non-deducted IRA. That's one scenario. The other scenario is an after-tax 401k. Or in other words, making after-tax contributions to a 401k. So anytime that we see someone doing after-tax 401k contributions, usually that's just sort of a middle step in a whole nother topic called a mega backdoor Roth 401k. Non-deducted IRA contributions are also something that's super rare because we would usually suggest someone just do a taxable account instead. So this is likely not something that you'll ever see. But just to go over the way that it would be taxed is you would pay your taxes on upfront, your income taxes, or you'd pay the taxes on whatever you're putting into the account, same as the taxable. One of the advantages is that since it's in an IRA or a 401k, you're not paying any taxes while it's inside. It is tax deferred. So you could put in $100, it could grow to 150, you could buy, sell, you could get interest. You're not paying any taxes while money's inside the account. When you go to withdraw, however, you're going to pay taxes on any gains that you withdraw from the account. So you won't pay taxes on your principal that you put in, but any growth that you pull out, you will pay taxes on. So you could maybe consider this tax advantaged. Again, this is not something that's going to generally come up in most people's plan unless it's being used for a very specific strategy. So more or less, most people can ignore this funnel. The next two are super pertinent though. So the first one is pre-tax. So with this one, this can be a 401k, this can be a TSP, any kind of employer plan especially. You could probably consider a traditional IRA where you have taken the deductions as pre-tax as well, or at least I would. So we'll say a deducted IRA. I won't write it, but just know that if you contribute to an IRA and you deduct the contributions, I would consider it in this bucket as well, or this funnel as well. So the way that this one is taxed is you're going to put in money, like it says, pre-tax. So when you make contributions to your 401k or to your TSP, your employer is going to put those funds into that account, and you're not going to pay income taxes on that money that your employer pays you. So if you make $100,000 and you contribute $10,000 to a 401k or a TSP pre-tax, you'll only pay income taxes on $90,000. That other $10,000 that you put into that account goes in pre-tax. So it lowers your current taxable income. That's one of the big advantages of the pre-tax account. So you put in money pre-tax. When it's inside the account, it is tax deferred. So sort of like what we talked about, or not even sort of, just like what we talked about with the after tax, that money can grow, you can sell, you can buy, you can get interest. Anything that happens in that account, you're not going to be realizing gains. It's tax deferred. That's a pretty big advantage when we talk about retirement savings, because usually retirement savings are over a long period of time. And when we talk about compounding growth, if you're paying taxes, even if it's little bits of taxes year over year, it's reducing the amount that you have, and it's reducing that compounded growth. So tax deferred growth is a pretty big advantage. But then when you withdraw, this is the caveat. I said tax deferred, not tax free. So you're going to pay taxes. Not only are you going to pay taxes on what you put into the account, your principal, because remember it's all pre-tax, but you're going to pay taxes on the growth as well. So you'll end up paying taxes, and these are income taxes, by the way, not capital gains taxes. So these are income taxes on the full value of whatever you withdraw. Whatever you withdraw is considered income. Okay, so this is always an important caveat as well. Pre-tax accounts, and I'll go back over this, but pre-tax accounts are usually good for folks that are in a very high tax bracket or even just a high tax bracket, income tax bracket that is, and predict that they're going to be in a lower tax bracket in the future. And this applies to a lot of, if not most, Americans. When you are working and earning an income, your tax bracket is likely higher than what it's going to be in retirement, right? Let's go over Roth, and then we'll come back to that point. So a Roth account, we've all, or maybe not all, but a lot of people have heard of the Roth IRA. That gets thrown around a lot as sort of a buzzword for good reason. There are also Roth 401ks and Roth TSPs. 401ks and Roth TSPs. And other Roth accounts as well, but they'll work largely similar. So the way that these are taxed is you're going to, like the taxable or like the after tax, you're going to put in after tax money. So you're not getting any kind of tax break on the money that you put into these accounts. But then when it is inside the account, it grows tax free. So there's a difference there. Before in the pre-tax, we said it grows tax deferred. Same thing with the after tax. With the Roth, it grows tax free. And when you withdraw from the Roth account, you are withdrawing tax free. So you pay your taxes on your principal initially. So you pay taxes on whatever you put into it up here. But then when you pull money out, you've already paid those taxes on the principal. You've already paid those taxes up here. And then all of this growth is tax-free. So you don't pay any more taxes on those withdrawals, right? Again, you do pay taxes on what you put into it. So you're not totally skimping out on taxes. But all of that growth is then tax-free. So who is this good for? Roth is usually great for folks that predict that they're going to be in a similar or higher tax bracket in the future, right? Because if your tax bracket is relatively the same now as it's going to be in the future, why not just get all of that growth tax-free? Why would you push these taxes on the principal into the future, into the same or a higher tax bracket? We might as well get that growth tax-free. Sometimes we'll also get folks that point out, well, wouldn't Roth always be better because then you're getting a bunch of it tax-free versus over here you're paying taxes on all of the balance? The difference here is that, assumably, if you are putting in money pre-tax, you're paying less in taxes. If that affords you the opportunity to put more into the account, you have more starting balance, more compounding growth. The math works out to where if you're putting in the same tax-adjusted amount and you're in the same tax bracket, it doesn't really make a big difference. We usually just side with Roth when you're going to be in the same tax bracket, simply because it's sort of a bird in the hand worth two in the bush situation. So again, if you are in exactly the same tax situation when you're withdrawing as when you're contributing, then it actually doesn't make a huge difference whether you do pre-tax or Roth. If your tax bracket is higher in the future, Roth makes a big difference. If your tax bracket is lower in the future, pre-tax makes a big difference, right? And then again, with clients, usually the situation would be if it's similar now and in the future, we usually just go with Roth because it's a little bit safer. We assume there's more of a chance that their taxes are going to increase in the future than they're going to decrease, just because that's life for you. Anyway, these are the retirement accounts, okay? The last account on here, and we used to not go over this one on this graphic, but we recently added it, is the HSA. And we added it because we think it's very important, because it often gets overlooked in people's financial planning, or maybe not given the credit that it's due. Because the HSA is maybe the most tax advantaged account. So an HSA, and I won't draw what kind of accounts it is above because it literally is just the HSA, health savings account. This is a plan, and you can see on the right side there, this is a plan that's only available if you have a high deductible health plan. So through your employer or through the marketplace, wherever you get your health insurance, if you have a high deductible plan that's eligible for a health savings account, you can invest inside of an HSA. If you don't have a high deductible plan, then it's not available to you and you don't have this option. So you can just consider the other four as your options. The way that the HSA is taxed is that you get to put in money pre-tax. So similar to the pre-tax investment accounts or retirement accounts, you can put in money pre-tax. It lowers your current taxable income. Once it's inside, you can invest the often the majority of the account and get tax-free growth. When you withdraw it, provided that you withdraw it for qualified medical expenses, so you're withdrawing it and you're using it towards qualified medical expenses, then those withdrawals are tax-free. This is one of two ways that I know of that you can get the triple tax savings, where if you want to think of it this way, the government never even touches your money. You never pay any taxes on your earnings, on the growth, on the withdrawals. Notice I said one of two ways. So again, on this channel, we always try to speak to military, especially active duty veterans, and then sometimes federal employees as well. The only other way I know of this happening is for an active duty service member in a combat zone getting tax-free pay that they then put into their Roth IRA or Roth 401k or Roth TSP, excuse me, because they're putting in money that's after tax, but that money was never technically taxed because it was in a combat zone. So I'll throw that little caveat in there. But the HSA is probably the most powerful account. However, the caveats come in the form of you must have a high deductible health plan. Also, it can only be used towards qualified medical expenses. So those are the restrictions. Congress is not going to give you anything for free. There's no free lunches. So there's always going to be some kind of caveat. Either you're paying taxes up front, either you're paying taxes in the end, either you're waiting till 59 and a half, either you're only using it towards qualified medical expenses, or you're paying taxes all around. Those are basically your options. But with smart planning, you can make the most of those options. And when we're working with our clients, often we're saving much more in taxes than we're able to add in honestly any other facet of planning. It's a lot easier to add dollars in your pocket by not giving them away than finding them somewhere else, right? So we often can't go to clients and say, we're going to double your expected retirement income by doing this kind of magical or technical investment analysis. But there is a lot of times where we can go and say, we're going to utilize these tax accounts very efficiently. You're going to give a lot less money away, and you're going to have a lot more money come retirement or throughout retirement. The only other thing that I will add in with these retirement accounts is just the caveat of the taxable accounts. Sometimes you are paying capital gains taxes on those gains, depending on how long you hold those positions. So anything held over a year, you would pay capital gains tax, which is generally going to be lower than your income taxes. When we look at our clients and the planning that we're doing, that is a big consideration as well. And I wish I could give sort of a quick snippet on where to consider that, but it's just so customized to your individual plan. The other thing is, even if your taxes or your tax bracket is predicted to be lower in retirement, meaning maybe you're a high earner, but the only income you're going to have in retirement is Social Security, the only fixed income that is. If you put enough money away pre-tax, you may fill up those lower tax brackets and push yourself into a higher tax bracket, then making Roth look more appealing. So it gets very complex once you actually start looking at individual scenarios of which type of account we should be using. I gave you some general guidelines of what's your tax bracket now, what's your tax bracket later, but there are things that affect that. What's your capital gains tax bracket? How much do you actually have saved in pre-tax? Is that going to raise your tax bracket in retirement? Things like that. The last couple of comments I'll make on this, and there's a lot of future videos that will go into some of these account types and just kind of planning details more in depth. But the last comment I'll make on this is back to the fixed income. So when we talk about how to fund retirement and having success in retirement, we're talking about how to use these investment accounts as efficiently as possible. All of these investment accounts, all of these investment accounts rely on the market. So you can diversify tax-wise among these investment accounts, but these all invest in the market. And you could technically invest them differently, but they're all going to be invested in some capacity. Where fixed income plays a huge role is making you less dependent on the market. So these diversifying between taxable, after-tax, pre-tax, Roth, HSAs, will diverse you from a tax standpoint and will reduce your tax liabilities, especially in retirement. Reducing your market risk, one of the best ways to do that is through fixed income. And again, I'm not referring to fixed income as bonds and interest-bearing vehicles. I'm referring to the guaranteed income payments in retirement. So things like annuities, pensions, Social Security, disability income, things like that. Okay. When you're in retirement, and this will be a future video, part of the planning is figuring out, okay, now how do we create income? What's the withdrawal strategy from these investment accounts into our spending accounts? And how much are we getting in fixed income or guaranteed income into those spending accounts as well? And how can we plan for that? And then keeping a certain amount of cash as well. So all of our clients, we usually coach to keep a certain amount of cash in retirement so that if the market does drop, well, they can turn some of these funnels off. They don't have to be pulling from these every month. Allow the market to recover, pull from their fixed income, have a little bit of cash on the side. As soon as the market recovers, then turn these sprockets back on and start pulling from those investment accounts. So this is the same exact presentation that we go through with everyone that we're doing a financial plan for. Hopefully it's been helpful. It really is just sort of an entry point into these account types and how to fund your retirement. We'll be doing more videos in the future on the specifics of each of these accounts and the planning that goes along with them. But if you have questions on them, please leave them in the comments and look for some of our next videos.